Hello everyone. Today's class will be very important. We will be studying about entry models. In ICT there are many kind of entry models that different traders use, but today we'll be learning about two very specific, very popular kind of entry models that we'll be using to take our entry from our POIs towards our bias. So first of all, we've got MSS, which is market structure shift. Now this is a high probable entry model, but the problem is that you are not going to see this often in the market. This will be rarely created in the market, and that's why you do not really get to use this as your confirmation most of the time. But whenever you see this will be a high probable entry model, and at least you will be getting 1:4 as your risk to reward. Now risk to reward is very important to talk about whenever we are talking about different entry model. So since market structure shift is a low probable entry model, you are going to get 1:4 most of the times, or maybe a little bit higher, 1:5, 1:6, depends upon the, you can say, the gap between your entry and the liquidity, which will be your target. But 1:4 is basically the standard, you can say, risk to reward that you can get in gold. Now I trade gold most of the time, so I know this from my experience that if you use market structure shift, then you'll very easily get 1:4. Now let's come to the second kind of entry model, which is called displacement, basically fair value gap. So when market taps into a POI, it needs to create fair value gap. So this is what displacement means. Now this is used when the market structure shift level is too far away. That is why we use this entry model, which is displacement. Now this will be the one that we'll be using most of the times, but the problem is that this is a low probable entry model. So we are going to lose out a lot of times. So that's why we need to keep a higher risk to reward in this entry model, which will be once again for gold, specifically 1:7. Because you are going to lose a lot of the time, so whenever you are going to win using this entry model, which is displacement, you need to get a good risk to reward so that you can recover all the losses and you can also make some more profits. So this is basically for gold, 1:4 and 1:7. But if you trade any other pair like Bitcoin, I've seen in Bitcoin also it gives similar kind of risk to reward for market structure shift. You can easily get 1:4, 1:5. But yes, for displacement, you do not really get this high risk to reward. Maybe you get 1:5, something like that, around 1:5. Now this is for Bitcoin and also for the Forex pairs as well, like the currency pairs, the USD pairs. So there also you get this kind of risk to reward. For market structure shift, you get around 1:4, and for displacement, you get around 1:5. But for gold displacement, you get 1:7. And I will show you some examples, and obviously I'll be showing you in gold because that's where I have my experience and that's what I'll be showing you. But make sure whatever pair you trade, you actually practice this. You see whether market structure shift is working and whether displacement is working as well, and what is the win rate of both of them. Make sure you take a couple of trades just based on market structure shift and also based on displacement, and see what is the average risk to reward that you get, and you can stick to that particular risk to reward, and you'll be only taking your entry when you get that risk to reward. Lower than that, you are not going to take your entry. Okay, so keep that in mind. That's very important. Okay, so now let's first of all talk about market structure shift. So it's very simple. Let's say we have got a point of interest over here, a high time frame point of interest. Let's say this is a daily POI. So as you know, if it's a daily POI, we will look at the 1 hour time frame structure. So let's say the 1 hour is dropping like this. It creates this last high, and the market drops, taps into the daily POI, and the market pushes higher and breaks above the last high. So what is this? This is a market structure shift. That means the market structure has shifted from being bearish to being bullish. But along with market structure shift, we also need to see fair value gap getting created. That's very, very, very important. When you see that, you are going to take your entry either from the fair value gap or from the order block, depending upon which one gives you your specific risk to reward, which is 1:4 in case of gold. So depending upon that, you'll be taking your entry. If your fair value gaps gives you 1:4, then you'll be taking your entry directly from here. But let's say that the liquidity is over here. This is the last high. Okay, this is the last high, and let's say before that market was just pushing to the upside, something like this. So in that case, your target is going to be this high, right? So in that case, you have to adjust your entry, because you cannot adjust your target. You cannot push your target higher. You have to adjust your entry in such a way that you get at least 1:4. Okay, so keep that in mind. So this will be your entry for the market structure shift. Now this is for buying purpose. The exact opposite thing will happen for selling purpose. We've got a daily zone. Market pushes higher in the 1 hour, taps there, and then shifts the structure to the downside, and then we'll be looking for a selling entry from the order block or the fair value gap, depending upon which one is going to give us our specific risk to reward 1:4. This is very, very important that we focus on the risk to reward. If the market structure shift is giving you 1:2, then you are not really ready to, you do not want to enter from this zone, and you do not want to take this target. Take this trade basically. Because why do you take it? Because it does not align with your risk to reward. Now that's very important. So that's why I talk about risk to reward along with the entry model. Yes, you can take. It's completely up to you. I'm not saying that you should not take, but I'm just saying that you should keep a healthy risk to reward with your entry model. Obviously, that your entry model provides. If you trade a pair that does not give you 1:4, and most of the time it gives you, let's say, 1:2, 1:2.5, and you're just waiting for 1:4, and you are just leaving all these trades, these high probable setups, because these are high probable setups. Market has given the structure shift along with fair value gap, so these are high probable setups. So most of the times they're going to work. So in that case, you have to understand that you are not going to get 1:4 in that particular pair. So if that pair gives you 1:2 or 1:2.5, then that's what you have to trade, or you have to shift to a different pair. So that's completely up to you, but you have to keep in mind the specific risk to reward along with the specific entry models. Now you will only get that when you practice this on the charts that you trade. So this is market structure shift model. Now let's see an example. Now, like I said, this does not happen very often in the market. So I've chosen a very specific entry on a very specific day. I think it was over here. Okay, yeah, I think this was the one. Let's see. Okay, so what's the bias? First of all, our bias is bullish. No question about that. Market is pushing higher, right? There is no question about that our bias is bullish. And we can see market has dropped, and market has tested this daily order block. And from here, market is pushing higher, right? So now let's see if market is able to push higher. Okay, so market has pushed higher once again, and market has created a POI over here, right? So now we know if market drops, test this POI, then from here we'll be looking to buy gold. So let's see what happens. So market drops, as you can see, and market taps into our POI. So now we'll be using market structure shift. So let's go to this day, and let's go to the 1 hour time frame. So in the 1 hour, we can see that market drops, taps our POI, and from here market gives a reaction initially, but after that market drops once again, creates a new low, right? And till now the 1 hour has been making lower highs and lower lows, right? You can see market is creating lower highs and lower lows, but from here market actually pushes higher, and market breaks above the last high, giving us market structure shift. And along with that, like I said, we also need to see fair value gap getting created. So we can see that market has created a fair value gap over here, and below that we have got this order block, right? So we can take our entry from the order block over here. You can see there is another order block below here which is still untested, but whenever there is a market structure shift and there are two POIs which are untested in the 1 hour time frame, in that case the first POI will be the most important POI, and most of the times market will just tap it and then market will push higher. So we can take our entry from the order block, stop loss will go below the low, and our target will be the last high, right? So this will be our liquidity. So this will be our trade setup, which is going to give us 1:4.2. So that's a good risk to reward, so we can take this setup. So let's see how it plays out. Let's go to a higher time frame. Okay, so we can see that market is pushing higher and eventually it gives us our target. So this is what market structure shift is. We are going to find our bias. We're going to mark our POI. We're going to wait for market to tap into our POI. And from here, we need to see the structure shift from the bearish to the bullish if you're looking for buying. And the exact opposite thing will happen if you're looking for selling. Okay, and once again, keep the risk to reward in your mind. If it is not giving you the specific risk to reward that it should, that a specific entry model should, then you are not going to really execute that entry. You can take that entry, but once again, this is something that I think you should take note of. Okay, so this is what market structure shift is. Very, very simple. Now let's talk about what is the next kind of entry model, which is displacement. So this is also very simple. Let's give you one more example. So I'll just remove everything over here. Let's say we have got a POI over here, a high time frame POI. Let's say once again, this is our daily POI. So market is dropping and we're watching the market in the 1 hour time frame. Okay, so market is dropping like this, and then market drops all the way down and taps into our daily POI. Now our market structure shift level is here, which is too far away from our POI, right? So now if we wait for the market structure shift to take place before we take our entry, then we're not going to get our entry, right? In that case, instead of using market structure shift as our confirmation, what we see is that after market tapped into our POI, was there a displacement? That means, was there back-to-back candles from here, which indicates that buying is taking place. So if after tapping our POI, market starts to push higher and creates displacement, that means fair value gap, that indicates that the smart money is actually buying from the zone. And this is what displacement is, basically creating fair value gap. Once we see that, then we can take our entry and we can target the last high. Now, like I said, in case of gold, I like to see 1:7 in this kind of entry model, since this is a low probable entry model. But the thing is that most of the times you are going to see this kind of price action in the market, where market will directly drop to your POI with back-to-back red candles, and then market will start to push higher from here. Most of the times market is not going to give you market structure shift as the confirmation. So in that case, you have to use this particular entry model. The exact opposite thing will happen if we look to sell. Let's say we're looking to sell and we've got a daily POI and market pushes all the way up, taps into our POI. Now from there, we want to see market starting to create this kind of back-to-back red candles, and along with that we want to see fair value gap getting created. If we see that, then we'll be taking our entry so that our risk to reward is 1:7. Here we do not really want to focus on taking the entry from fair value gap or the order block, because since this is a low probable entry, what market does is market will go all the way down, and most of the times if there are wicks on this first candle, if you see wicks like this on the first candle, market is going to tap into that wick and then market is going to drop from there. So this kind of entry model actually gives you a higher risk to reward compared to market structure shift. But this is a low probable entry model, so it has a lower accuracy than market structure shift. But this is the one that will be seen most of the time in the market. Okay, now let me show you some examples based on this one. Okay, so if we see recent price action, then here you can see what market did was market dropped all the way down and it tapped into a monthly order block, right? And from here there was a very strong upside push. Now if we go to the daily time frame, since this is a monthly POI, we'll be looking at displacement in the daily time frame, right? We have studied this already in the time frame alignment. So we can say that market pushed higher and market has created an order block over here, right? So once market drops, we will be looking to enter from this order block, and according to the daily, our target will be this liquidity. Now let's see if market actually gives us market structure shift in this entry. So you can see over here, market directly dropped to the downside without even giving us any kind of market structure shift level over here. So in that case, what do? Do you just lift the entry? No, in that case, once market taps into our POI, you want to see displacement in the 1 hour time frame. Why? Because this is a daily POI, and as you know, if this is a daily POI, then we want to see our entry from the 1 hour time frame. So that's why we'll be going to the 1 hour and we'll be watching for displacement. So here you can see that market tapped and immediately market pushed higher, and also market created this fair value gap over here, indicating the involvement of smart money. So what you will do is you will take your entry from that level, which is going to give you 1:7. In this case, this will be this level, and you can see market came down and market exactly gave you the entry, and then market afterwards started to push higher, right? So in this case, you can see that market has created a massive wick on the downside. So like I told you, in this kind of entry model, market will give a very deep pullback. Most of the times it is going to tap this wick, and then market is going to push higher. So this is what displacement entry is. Now if I show you some more examples, then let's go over here. Let's see this movement to the upside over here. I think you can see some good examples of displacement. So I'll be removing this, and you can ignore this one now. So let's just come over here. So we can see that market is creating all-time highs, right? And market is pushing higher. So our bias is very clear. We'll be looking for buying opportunities only. So we can see that market is pushing higher. Let's place some more candles. Okay, so we can see that market has created again displacement over here, which is fair value gap. And after that, market has created this fair value gap, tapped into this fair value gap. And from here, if we go to the 1 hour time frame now, let's see if market actually gave us any entry. So we can see after market came down, tapped into a daily POI, market started to push higher, giving us fair value gap. So once again, we'll be taking our entry in such a manner that it gives us 1:7. Now once again, this is very specific for gold, but for other pairs you have to test it out and see what kind of risk reward does this particular entry model give you. So you can see that market gave our entry, and from here market started to push higher. Once again, market dropped, tested this week on the downside. Like I said, most of the times in this entry model, market gives a deeper pullback before market starts to push higher. And now if I play it further, you will see that market actually starts to go up and gives us our target. Now let's continue this. So market is still bullish, it's still pushing higher. Let's place some more candles. So we can see that market is pushing higher, and here market has created another fair value gap. Now once again, let's go to the 1 hour time frame and see what market does over here. So here, is there any POI that market has created? So yes, we can see in the 1 hour market has created a fair value gap, which makes this an order block. So we do not really care once again about where the order block is. Like I said, most of the times market will drop and give us an entry from the week of the last candle. So let's see if market actually gives us our entry on this one or not. So this will be our entry. Our risk reward will be 1:7. So let's see what market does. Okay, so in this case, I don't think market gave us our entry. Market came down, tapped into this order block, and directly market pushed up from here, which is completely fine. We do not have to catch every single move. We'll be following our entry model and our specific risk to reward, which that entry model gives. Now, once again, market was pushing higher and market created another fair value gap over here. So let's see if market gave us any displacement in the 1 hour time frame. So we can see that here market actually, yes, it dropped below this fair value gap, but immediately market started to push higher and market created displacement in the 1 hour time frame. Now remember that any POI, it is not invalidated as long as a candle closes below that POI in the same time frame. Now since this is a daily fair value gap, if this daily fair value gap needs to become invalid, in that case this daily candle needs to close below this fair value gap. But you can see that did not happen. Market came down, market just created a wick, and after that market started to push higher. So as long as there is no closing at that same time frame, that POI is not invalidated. So you can see market dropped and immediately started to push higher and created displacement over here, right, in the 1 hour time frame. So we can take our entry once again based upon our risk to reward, which is 1:7. So this is going to be our entry. So I'll just adjust it to make it 1:7, and here it is. You can see that market dropped and gave us our entry, and after that market started to push higher. So now if we just resume it, you can see that market went up and market has given us our target. So this is what displacement is, okay? And once again, remember, as long as there is no candle closing below a particular POI in the same time frame, that POI remains valid. Okay, so keep that in mind. Apart from that, I also want to tell you a very important thing. Let's say there is a POI over here, and let's say market drops, okay, like this. And after that, what market does is, let's say market directly drops and taps into our POI. So in this case, our market structure shift level is going to be over here, right? So once market taps here, the market structure shift is too far away. So that means we'll be looking for what? We'll be looking for displacement. We'll be looking for fair value gaps getting created. So let's see, we have got this kind of back-to-back candles. So we see displacement. So obviously we're going to take our entry as such that we get 1:7. Our target is going to be the last high, right? So this will be our entry. But let's say that the market actually fails to push higher. Market will drop, market will give a reaction, but market fails to go and target our liquidity. And then market drops once again and takes out this last low. That means it takes out our stop loss. In that case, does that mean that market is going to push down from here? No. In that case, what you will do is, as long as this zone is not broken, like I said, this zone is still valid. In that case, you will wait for market to give market structure shift next. So if that happens, in that case, you'll be taking an entry after market gives a pullback to the fair value gap, which needs to be created along with the market structure shift. So you'll be taking your entry from there and you'll be targeting the last high. So basically what you have done is, the POI is the same, but initially market has tapped into your POI, and since the market structure shift was too far away, but you saw displacement, you took the entry with the proper risk to reward, but market failed to push higher and give you your target, and market drops and takes you out, right? But once market takes you out, does not mean that you'll be looking for sell straight away. Wait and watch the reaction what market does, because it might happen that in that zone only market will give a market structure shift, and if that happens, then we'll be looking for an entry. Once market comes down, taps into your POI, from there we'll be looking for an entry and we'll be targeting the risk to reward, which will be based upon market structure shift. Okay guys, so this is something which is very, very important, so keep that in mind. I do not really have an example of that, I could not really find, but yes, I remember taking a similar kind of entry some weeks back, but I could not really find this particular entry, this particular example, so that I could have shown you in the chart. But yes, this is something that actually happens in the market, but not too often. Either market will give market structure shift directly, which is obviously not going to happen most of the times, which will happen rarely. Most of the times you'll be seeing displacement, and this is where you'll be taking your entry, considering your proper risk to reward. But once the displacement fails, you are not going to directly go for a sell. You will wait for market to actually give a structure shift, and if market gives that, then once again you'll be taking your entry from that particular POI. But yes, if market is not able to give market structure shift, and if it directly drops from here, then obviously we'll be focusing on the lower POIs. Okay, now if I get an example of this one, then definitely I'll be sharing with you guys. But yes, this is something that you have to keep in mind. Initially, if displacement does not work from the same POI, you'll be waiting for a market structure shift. If you see that, then based on that, you'll be taking your entry. So that's the entry model that you need for trading not just gold, but any kind of market. The same thing can be applied for Bitcoin as well, and also for currency pairs.